And joining me on the podcast right now, and of course, live in technical, not as high vis as I am though, but it's Paul Hill, equity analyst. He brings the energy, I bring the shirts. You all right, fella?
Yeah, morning, Justin. It certainly feels as though it's been a very long week after all the carnage, particularly on NASDAQ, and I'm sure quite a lot of it's to do with the bloodbath in the crypto area. I mean, you've probably been reading about it, but all these so-called inverted commas stable coins haven't been ridiculous. Quite so much, is it? I mean, Luna hasn't really gone to the sky. It's gone to the bottom of the ocean, I think. People have lost. In fact, I think this morning I just saw it. I mean, it's almost 100% value. I think has been destroyed.
Gone, yeah. There's a lot of sort of, a lot of high net worths in that as well. I saw this guy called Mike Novogratz, who's I think is a billionaire, was talking about that a lot. And they've all of a sudden gone quiet on it, you know? And the thing is, these stable coins have been around for a while. Now, the worst one yet still is Tether. That's the biggest one by market cap. So 80 billion, it's supposed to have that in dollars as you know, on its balance sheet. They've never actually produced any evidence of where the money is. They did say for a while it was in, it's not all in cash. Some of it was in paper. Some say it's in Chinese debt. Oh my word. Now, if that topples over, that will have massive contagion throughout the crypto markets. And Janet Yellen this week was questioned about this. She said, yes, we're going to have regulation on stable coins this year. So I think that's very good because there's a lot of dodgy things going on. And these kind of, you know, Ponzi or fraud schemes, I'm not saying they are, but they can go on for a long time undiscovered, especially in new markets like this, where there's no regulation. And so you don't know what's going on under the hood at all. And so I don't think this is I mean, Bitcoin at 26,000, and that was like a 60% drop this high. Yeah. But I don't think we've seen the bottom for this. I think there's a lot going on in the crypto markets, you know, it's down to fraud, and I think it's gonna unwind a little bit, you know, really is.
I think you're totally spot on. I mean, you're a better expert than I am, but just looking as an external observer in, it seems to me, you know, it's got lots and lots of commonality with the great financial crisis, because then you had all this sort of toxic subprime debt on banks' balance sheets that frankly had been put on there at par value, but were worthless because it was backed by houses that didn't exist or people who couldn't repay the mortgages and all that kind of stuff. And hence you saw Bradford and Bingley and Northern, people like that going bust. But I'm with you. I think actually a lot of investors and retail and even professional institutions have been sold a total pup on these stable coins, that they've been asset backed, and in reality they're not locked to a hard currency like the dollar. They're locked to basically loans that may well be in dollars, but frankly are then itself backed by really dodgy institutions or people, or, you know, structured products, leveraged debt, all that kind of stuff abroad, or not even in not regulated markets. And I think they'll just that asset backing will just vaporize. Yeah. And what you've seen is not only obviously that's impacted the really sort of extreme end of the stable coin market, the algo side, the USTs and the Lunas, but has also sort of like it's impacted a lot of the FANG stocks out in NASDAQ, because they've been used as a source of funds and been sold down. So I'm sure that's got to be to do with why Apple and Amazon and all these others have had such a hard time of it over the last 2 weeks, as they've been sold off hard. And in fact, they're in bear market territory now as well. And that just seems to be too coincidental that there's been so much, you know, sort of carnage in the cryptocurrency side. So I'm with you. I think this could actually prove to be a major, but it's never, if genuinely it's a fraud in certain areas, or Ponzi scheme, whatever we want to call it, or just you know, they're unstable coins, then effectively the fundamentals, as we always say, ultimately will win out, and people are going to get a really bad sort of like wake up call. So I'm glad I stayed clear of it.
Yeah, but the thing is, they can go on for ages, these frauds. We know that before they actually get investigated. It takes a long time to go through all the paperwork. But I think, I don't know if I'm correct here, but if you look at the biggest cryptocurrency coins, you've got Bitcoin at the top there, which is, what's the market cap on that now? It's at 580 billion. You got Ethereum, 251 billion. Tether The third largest is a stable coin. It's 80 billion. Now, if you look at all the companies around that have valued at 80 billion in the UK, they have to report their accounts on a proper basis, timely basis. And Tether, I don't think they've reported anything since 2018. And now, even now, they've been asked by the SEC to do it, and I don't think they have. So you think, why wouldn't you do that? I mean, people say, well, they're just, it's complex. No. If you want to clear your name, the CTO and the CFO saying it's all above board, just publish your accounts officially. Show them. Why wouldn't you show them? To me, that stinks. That says everything. So if that goes down, that's really worrying.
I'm with you. And hey, once the confidence goes out of if it goes out of Tether, which frankly could well do quite soon if there's no real sort of asset backing, but there's no asset backing at all for Bitcoin. There's nothing. There's absolutely zero asset backing. I mean, it is, as John Paulson said, a very famous hedge fund, it's a limited supply of nothing. There's no asset backing at all for that.
It's just, if something goes up, some people think that justifies the valuation. It doesn't. It just means it goes up.
Yeah, exactly.
I know, and it means it can come back down. I've said this about a lot of people. I don't know if you notice on cryptocurrencies, there's something called staking. Basically, if you hold, the cryptocurrency rather than trading it, they can give you yield on it. They can pay you, and I think, and people think that's fine. You can earn money off. I said, a yield of what though? If something's worthless, doesn't matter how much they give you of it, it's still worthless. I mean, you may think you're getting 10, 20% yield, but of what? I mean, if they collapse tomorrow, that yield's worth nothing. So I know. So there we are.
And I think we're going to start seeing this as essentially you get more volatility with interest rates and bond yields and tightening central banks, and also obviously unfortunately the Ukraine-Russia crisis seems to be progressing. Oils are sticking above $100. As you've got that scenario, that backdrop of tougher monetary conditions, it's much harder for companies, good companies in fact, to raise money. But any dodgy companies, any other, or you're trying to raise funds in terms of IPOs and this sort of stuff, it's really becoming tough. And so I think this is just the start of a number of real sort of like areas that should have tipped over, years and years ago, but have been really allowed to continue on ultra loose conditions. And they're having their day of reckoning, or they will be in the near future. So I think investors have got to be very, very selective, and balance sheets will be increasingly become more important, because people won't just say, okay, well, it doesn't matter. They're going to make profits in 2, 3, 4, 5 years, because they may not be around in the light of day.
But do you know what I saw? I think it was a stat on CNBC or something yesterday about the number of IPOs, and I don't know what time period. I think it was this year, but they're down by 90%. I think it's something like that. So and that just shows that money's hard to come by. People don't want to raise money at the moment, or they're scared to. And so people, and that shows you. And just look at look at the indices. In fact, here's the question. It's probably unanswerable, but if anyone can answer, you can, Paul. So if you look at the indices across the board here, look at AIM 100. It's done 32% down since the 6th of the 9th last year. Russell 2000 down again 30% since 8th of the 11th, and NASDAQ's down 30% as well, same period. S&P actually dipped into bear market territory yesterday, but come back out, went 20%. And then, so the markets are correcting, of course, because they're saying it's going to be a lower growth environment, higher interest rates. How does the markets know how much to correct by? Let's say we have 10% inflation. Let's say it's going to impact the growth. How do they know? I mean, have we overcorrected enough now? Is that all priced in? Because let's be honest, when you get a 30-odd% drop on an index like the Russell 2000 or NASDAQ, they're priced in quite a bit in, aren't they?
It's a brilliant question, and there isn't, unfortunately, there's not a proper answer. But I would add, as a bit of context, there's two ways of sort of gauging this. Okay, you can gauge it from a technical perspective, which you're the expert more than I, or a fundamentals perspective. Okay, and let's just take the world's biggest index, the S&P 500. Yeah, on a technical perspective, on the sort of like the RSI, it is definitely oversold. I mean, I think yesterday when it started to drop again with that volatility, I think it was on about 31, 35, something like that. So it was massively oversold, which is only really where it hit around about the pandemic of last year. So on a technical basis, it was on the chart is
30.85. It's
well, there you go.
Yeah.
Exactly.
Yeah.
So it's definitely oversold. However, on a fundamentals basis, when you look at it, I mean, I'd have to look at it now to a certain extent, but I think the S&P trades on a forward price earnings multiple of about 17, and it appears as though some of the earnings estimates are rolling over, and it's a matter of time before they get those feed through. So it probably is slightly higher. And but even if it is a 17 times a proper, 17 times earnings multiple going forward, that's actually probably around about fair value in historical terms over the last 5 years. So all I would say, fundamentally wise, on an average basis, the S&P doesn't look hugely under or overvalued. It looks about right, but you can certainly, there's a lot of stocks which are fundamentally massively undervalued if you choosy. But on a sort of short-term chartist perspective, yeah, it looks massively oversold, and we're when we entered bear market country. But it doesn't mean that it ain't going to go lower if you still get another monetary shock. All I would say is that I think you and I have I think we've still got the right view. Small caps entered bear market territory 9 months ago, and the great financial crisis was a very good sort of like movie in the fact that it entered bear market. The AIM index, or a lot of the AIM stocks, entered bear market territory or got mullered in 2007, whereas the FTSE only hit its bottom, its nadir, in April, March 2009. So 12 months, 18 months later. And on that basis, then I think, coming out of this, the small caps are going to do well, and I can see it through my own portfolio. I mean, I can't believe the bargains out there at the moment that are available. But just coming back to your point in terms of it's difficult to raise money. Well, one company is there is still a capital available for really good investment stories, and one company that I've been talking about, which is the basically does portable oxygen concentrator, Belluscura, pioneer into that, is actually in the process of raising money at the moment. It announced yesterday it's looking to raise $5 million, I think it was, or pounds, £5 million pounds. Yeah, £5 million pounds net at about 4.7. Hasn't actually finalized that, but it's almost certain going to do that. And it just shows that there should be money around for compelling investment opportunities. And what are they planning to use the funds for? Well, it's really to, as you probably know, and we talked about, they signed this transformational manufacturing agreements with a very large contract electronics manufacturer out in China, and those funds are then being used and deployed to start that contract and then to commercialize the portable oxygen concentrators largely within Asia. And this is a huge market. I mean, you've got literally 100 million people in China who suffer from respiratory conditions, and you've got another 50 million in India, and I think another 5 million in Japan. So this is just frankly enormous numbers that really is going to have a huge commercial advantage in terms of the actual sales, but also because you've got an increased scale and footprint, it's going to massively drive down, the sort of the cost base and improve unit economics and gross margins. So it's going to be a win-win situation, this. And I mean, frankly, £5 million is a drop in the ocean. So I'd be stunned if they don't, put an announcement out later today saying that they've actually done that. But that is just a terrific endorsement of the technology, of the management team. And also the other thing to think about is that the main players in this market for portable oxygen concentrators, they've either got significantly inferior technology, or the actual leader, Inogen, is really struggling to supply product because it's had a supply chain issue, and it went to just-in-time stock management just before the pandemic hit, and found out actually it hasn't got any stock, and it's really having to sort of like put quotas out to its customers. So this is a really perfect sort of demand environment for Belluscura to really sort of like grow its sales. And I mean, when you run the numbers and you look at sort of like push the clock out using the house brokers numbers but to, you know, putting a multiple on it sort of to 2025, you can easily see how the shares could hit sort of £2 again, you know, certainly above 180. And I think Dowgate have got a target price of about 180. That's pre the actual any dilution of the potential fundraise. But given the other thing to think about is that their 180 was done, I think, at an exchange rate of about 135 against the dollar. Now it's 122 or something to 123. So you probably find it hasn't changed, even if they issue more shares, because the dollar has strengthened against the pound.
Yeah. Do you know what? That's one of the things I'm thinking about. Is you talk about supply chains there. Now the market's selling off because, I mean, just look at the fear ingredient index. It's down at 6 now. It was down at 3 when we went into a pandemic lockdown, and we didn't have a vaccine, so there's a massive unknown there. You know, global economies are shutting down.
It's down to 6, is it?
Yeah.
6.
So I'm thinking,
wow.
I did say on Twitter, I said, if you only ever buy when this goes into single digits over the longer term, if you ever top up or buy investments, you know, when these are in single digits, you do well over the long term. But is it part of the reason why, you know, this uncertainty of inflation and also supply chain? You've got China there happening, where you don't know what's happening with those guys there, you know, zero COVID tolerance, which insane, you know, insane policy.
Oh yeah.
So it's a lot of unknowns out there, and the market, you know, that's the thing, isn't it? The uncertainty is what the problem is, I think, isn't it? You know.
Yeah, and also we've had 10 years, or really 12 years, you know, the great financial crisis, of super lax monetary policy, which has put a lot of investors have gone, you know, on leverage and have been buying on margin, using derivatives and all this sort of stuff. And that's, you know, that sort of built up within the system. And at some point it's got to sort of like deflate. And when it does, people get very scared. And also you've got a decade odd of new investors who have really only seen the market go up. And on that basis, they've never really come against tougher, you know, tougher conditions, tightening monetary policy. And they're struggling. They feel effectively they're sort of like losing their heads. They're just running by their emotion, and their brokers are basically saying, well, okay, sorry, you're going to have to put up some more capital, or you're going to have to sell. And so you get that sort of level of distressed selling. So I actually think it's healthy.
It is. I mean, if you look at the S&P, it's ridiculous. I mean, the chart, it's just gone up and up and up. You've had some dips, and then you had the dash for cash crash, and then all of a sudden it was on steroids. It just went straight up after that almost, and now it does need to roll over. It is the hangover after the big party, a 10-year-long party, pretty much. But it needs to come down. I don't know. Do you know what? It looks like a sensible level. Be up, you know, 32, 3,400. I mean, it's at 39 now, but it was at 48. But it's nuts. Cool. What's the next?
I mean, all I'd say is that, you know, there's plenty of bargains out there, as we've said, in the small cap sector, and one of them sort of like is, you know, I'd point investors to that I've got right on my radar screen, I've had for some time, is Revolution Beauty, and I've talked about this before. It's the, you know, it's a challenger cosmetics, sort of hair care, skin care products brand that is really expanding across the UK, Europe. But the States now is the biggest market, I think, on a store basis, and also into Asia and Australia, etc. So it's a real global brand that's taking market share. Sales are just shy, or they were, of 200 million, but I mean, they've got a really, really ambitious management team led by Adam Minto there. And he's hoping to get to sort of sales in 5 years around about, you know, $1 billion from just less than 200 million. So huge growth potential. And you can see why, because, you know, the sales are sort of like going up very strongly on double-digit basis. And, you know, they've got the increase in the footprint with really leading retailers like, you know, Boots and Walgreens and Ultra Beauty out in the States. So they've got fabulous sort of like, you know, and Superdrug, fabulous sort of like, you know, retailers supporting that actual brand. And they've really only been sold off simply because of, you know, concerns over the consumer and how inflation is going to affect them. But let's be clear about it. This year, people want to go out, and we've seen that already. They want to go abroad, and they're going back to work, and you know, people are going to use cosmetics. I mean, even blokes are starting to use cosmetics, but I'm not. But you know, I mean, lots of people do. And on that basis, then you wouldn't need any of the hair products, that's for sure.
No, but I can't be bothered to shave, let alone use all that nonsense. Go.
You might need some detergent instead for your shirts. But but anyway, they're doing great. The shares are sort of like, I don't know, 110 or 115 or something like that. And you know, the house broker have got a price target of 190. But if they hit their numbers, you could see this flying 3, 4, 5 quid, no problem at all. And you know, they're onto a boat. Anyway, they swapped out it's just as business usual. They swapped out their CFO, who's done a terrific job, Andrew Clark, over the last 3 years, bringing the business to market and IPO, and he's decided actually wants to sort of like, you know, step down. And they've brought a lady called Elizabeth Lake, who actually is, strangely enough, is another alumni of Southampton University. She graduated a year after I did, so I'm looking forward to touching base with her. But anyway, she's got a much better CV than I have. She's the ex-CFO of Everyman Media and Science and Sport.
Oh, Science and Sport, yeah.
Yeah, so she's a real sort of like industry expert, and will bring a bit more ability to scale that internationally, and to really get, you know, if they need any more capital to accelerate that growth story even further, then she'll be an ideal asset to be able to do that. And as I say, Andrew's done a terrific job, but he wants to do other things, so which you can understand, because he's been working really hard for the last three years bringing the business to market. But with Elizabeth and Adam, you can absolutely see how this business could hit its its ambitious targets of five-folding revenue. You know, so definitely one that's been, in my view, has been unfairly hit. You know, simply because it's got associated with the consumer.
Yeah, well, so many companies are. I was chatting to someone, I think on a chat group, the investment club there, and I was saying, it's a webinar. I said, I like theatre, you know, and SED. I said, at the moment, he said, do they have to buy in now? I said, well, listen, fully research it, because that's the thing with bear markets. You've got plenty of time. You know, you can take your time researching companies. In bull markets, you can almost find something in a hot area like theatre, for example. You know, you research it, you can jump up 20% in a day. You think, oh my word, I missed out. You have FOMO and jump in. But I said, in bear markets, you can just take your time, do the research, because you know the current is against all stocks at the moment. So it's hard. You know, it's hard if you're holding, but researching, perfect. Opportunities are created here. You know, absolutely.
Yeah, I mean, I wasn't going to talk about Theatre, but frankly, I think that looks like an absolute, great bargain, because those shares have come off, haven't they? And I can't remember where they are last saw, but what they are, 154 today. I mean, that just looks like, frankly, marvelous value. So. Yeah, I mean, I don't want to sort of like preempt things. Well, let's see what the news flow comes through. But as soon as they start signing some large sort of like, supply contracts, or, joint ventures or franchise deals or anything like that, particularly out in Asia and India and China, that's just going to go to the moon, So
well, do you know what? It's funny. I was saying that if you look at, we're worried about a lower growth environment, and of course that's they're talking about GDP. But surely in this time, this period, this environment, it's a very good excuse to go looking for high quality growth stocks, because if they can exceed their peers and everyone else, looking for best in class. Growth is what you want, really. I mean, there's been a value play for a while, but I think it'll go back to growth. I mean, of course, the ridiculous valuations in America, where you're talking to 100 times sales, is ridiculous. I know, but I'm talking about sensible valuations with good growth in growing industries. I mean, now is the time to look for those the kind of companies that exceed, the rest of the economy there. Absolutely, yeah. And
well, I mean, you've got
top line growth there, huge end markets.
I think, and also I think you've just raised a fabulous point in the fact that the fundamentals in a lot of industries are still pretty solid, even though the share prices are on the floor. I mean, one of them is the UK building products sector, and I point to sort of Michelmersh, who came out with an AGM statement in line this week. And all I would say is that, yes, the industry stats for sort of like, building products is slowing down. It's still growing, but it's slowing down slightly. Yeah. But even if it's forecast to slow down, even if it is forecast to slow down, it's coming from record levels. So it's still really healthy. You're going from 120 mile an hour to 100 mile an hour. I mean, you're still growing, and it's still significantly, really strong. you know, for sort of like for bricks and for building products. And the problem is supplying the product, never mind the, you know, sort of meeting demand. It isn't a demand issue. So there's still in excess a number of, you know, people who want to sort of like, you know, do repairs, maintenance and stuff. Anyway, the shares of Michelmersh, and again, the absolute top-notch premium quality brick manufacturer, great, you know, quality company. And its shares are off from highs around about 40-50%. I think there was, last time I saw it, about 115, 116p, trading on about 7 times EBITDA. And this business should trade on 10, 11 times EBITDA. So I could easily see 160p, you know, without any problem at all. And it's just been sold off. It's got plenty of cash. It's got niche positions in the UK, and it's got real long-term secular growth drivers. I mean, this thing's like, you know, basically the government is already apologizing why it hasn't been able to meet its promises to build houses and stuff like that. But also sort of like, you know, the housing stock in the UK needs renovating. You've got HS2, the new stations, you've got build to rent, you've got recladding. I mean, you've got just so much sort of building infrastructure that needs to be done. And I just look at it, and again, I mean, that's right on my button. And it's just been unfairly sold off because people, the investors have shot first rather than actually looking at the fundamentals. And the fundamentals, yes, they may not be quite as strong as they were 12 months ago or 6 months ago, but frankly, they're still really strong. You know,
and the housing market is funny. If you want to see the difference in the stock market and the real economy, look at something like a share price of Rightmove. You know, it's come off massively, and you think people are expecting a housing market to take a bit of a tumble. But you know what? There's plenty of people waiting for house prices to come off a bit. There's plenty of, you know, people always want to buy houses in this country. Always, they're thinking, look forward to that. They won't dip. House prices won't dip that much at all because. But even if they, plenty of people want to buy. Plenty of people want to buy. You know.
Yeah, well, I would agree with you. With nominal inflation at that 8 or 9%, are set to go to 10% by the end of the year, can you really see house prices decreasing when you get at nominal inflation of sort of like, you know, that of double digits? And I'm with you. But even if it does, even if they do fall down, you know, by 5%, it ain't to make a massive difference in terms of, you know, sort of demand and stuff like that. If anything, it'll probably go up, you know. So because they've just risen so strong, it still is going to be a really strong market. Anyway, you know, you can say what people have to take their own view, but you're right. There's a huge disconnect between the fundamentals and actually what the stock market doing. I mean, another one which has been, again, just absolutely mullered, and I can't believe it. Small cap with growth, and again, you know, they came out with an unbelievably good RNS yesterday. Verici, which is a next generation immunodiagnostics medical business based out in the States on Mount Sinai's technology that is really transforming the accuracy and the predictive capability of diagnostic blood draw tests for kidney transplants. And they said yesterday, because they've been, as you know, as I've talked about, they've been doing this sort of 15-month validation study of the underlying technology in 14 clinical centers across the world, been gathering all that data. It's taken slightly longer than they hoped, simply because of, you know, sort of COVID. It's drawn that out, and some of the patients have caught COVID and they've had to step out the trial and all that kind of stuff. But frankly, they came out with the results on one of the tests of their Tutiva, which is basically a post-operation blood draw test to see how the patient is accepting or rejecting that particular donor part, like, you know, the kidney, etc. And it came out with an unbelievable finding that yes, the actual test has got, you know, significantly better predictive capability, or they call it predictive, is it PPV? I think it's called positive predictive value, than any of its, you know, the nearest best-in-class tests and stuff. Now, I mean, that is just transformation. This is potentially a $400 million market just for that particular test. And they've got another test which have results in a couple of months, which is a prognostic, which is basically a pre-operation predictive test that has got an equally sort of near $300 million together, got about $700 million, total addressable market. And if one of them, again, this is a platform play, underlying technology, I'll be stunned if the results are any different. They're going to be, in my view, they're going to be positive, simply because if the science works for one, it's going to work for the next. So that's the Clara. And then what you're going to get is that you get this series of tests being put together that build up huge, sort of like some critical mass, and also barriers to entry for other people, because helps clinicians and doctors to see how patients transition between these various tests and that kidney transplant. And this is again an enormous market. There are about 100,000 people who have kidney donor transplants each year, but there's 3 times that on waiting lists, and probably another 3 times that who would like a kidney transplant, but not even on the critical path to get onto the waiting list. This could literally transform their lives, the patient outcomes, but also the accuracy and the matching of patients to donor organs. And it's just great news. Anyway, the detail of the stats and the data are going to be released, I believe, at this. It's a big industry conference in June, so only about sort of 4 or 6 weeks, etc. Which I think is I can't remember what it's called, but it's I think it's the American Kidney or Donor Transplant Conference. But that's all going to be revealed there when that happens. And American Transport Congress in June is where the actual the detail is going to be released. But the shares are about 30p, and they've come off from about 80 or 90 from a high. But the fundamental story's got even better, and the risk is reduced. I mean, it just is madness. So,
well, that's the market. Everything's rolled over. Even finally, Apple sort of rolled over this week. So, if they're punishing Apple, everything else, and you see this constant narrative now about any companies at early stage don't have profits, cash flow, get out of them. And thinking, hang on a sec, no, are you kidding? If you really want to transform your portfolio, you need some exposure to this company like Verici. Could be massive in a few years' time. You won't get those kind of returns from big cap stocks. So, there's always plenty of room for some exposure to these, best in class micro caps, small caps, because they can transform your wealth a little bit,
Yeah, and also I would say, I've spoken a lot, and I know you have as well, to Sarah Barrington, the CEO, and I've got to tip my hat to her. Every time I speak to her, she's top drawer. Absolutely. She knows what's going on in the industry. She's really astute in terms of commercialization, how she's actually going to position in the company to maximize the opportunity without ruffling too many feathers on rivals. And she's a really, really smart operator who's got a lot of industry experience, not only on the scientific side, but more importantly on the strategic and commercialization side. So I think once you've got a very sensible person who's directing the operations with transformational technology, you should get a good result. And obviously, one of the shareholders is also Christopher Mills, who's world class in life sciences. Yeah, and that also helps as well.
Yeah, absolutely. Yeah. Do you know what? The one thing I regret is not having more cash in these kind of situations. We know they happen. We know these big sell-offs happen, and they come around, once a year, pretty much. And yet it's not. It's just not this size and experience. But it's annoying, isn't it? I know you try. It's another way of trying to time the market. But I wish I just had more cash. You got plenty of cash or
no? I've been, as you say, I've been actually putting a lot of money to use over that first quarter, and it's been pretty painful actually. In fact, I've been redeploying capital. If I look at it, and if I've actually held all the stocks that I had before without selling them before, sort of like before last year, the year end, yes, I would have been further down than I am now. From all-time highs, but I've had a few bloodbaths. I've only owned Boohoo by about a year, and that's killed me, or 9 months. That's been a nightmare. Purple Briggs has been a nightmare, but equally I've had some sort of like decent successes as well, and I've you know, I'm deploying them in shares that I think will do well. I mean, one of them I'd point to is FD Technologies that came out with its prelims last week, and I mean they've got 3 divisions. I mean, they're a leading they're a leading sort of real-time big data analytics business that takes, you know, billions of data points from across the world, particularly in the sort of financial markets, capital markets, aggregates it for people, adds on obviously contextual data, historical data to give that level of interpretation as well. And they sell into most of the big sort of like, you know, merchant banks. But that technology is so good, they're also deploying it now to other industries like healthcare, to manufacturing, etc. And they're they've got 3 divisions. The jewel in the crown is the KX Insights business, and that exited last year on a run rate of around about 25% ARR growth, and that I could see that continuing. In fact, I think the board is saying it's going to go up by 30-35% the next 12 months. So that's absolutely flying, and I would value that on a sort of 5 times sales basis, which on its own you get to £13.50. And then when you add on the old First Derivative business, which is effectively IT support and software support and system support for a lot of for the financial community, the big bulge banks, you put that on a 15 times EBITDA multiple, which is about the same as sort of like just south of what Accenture's on. Then you get another £8.50, and then you add another. The last division is MRP, which is effectively lifting and shifting the KX Insights technology into the sales and marketing sector to help companies improve their sales leads basis, which is particularly important now that Apple has stopped cookie tracking, and Google will, because you need first party data, and you need advertisers need to be able to see what's working, what's not working. And I put that's again growing at sort of double digits. Financial First Derivatives growing at sort of double digits as well. That's another £4.50. You put a 25p on for cash, and you get to a share price, you know, some of the parts of over £26.50, no problems at all. And that's a conservative valuation, which I've done on some of the parts. But essentially, I mean, you've got the house broker, I think, on about 30 quid, and then you've got sort of Investec. I think that's Shore Capital. I think you've got Investec on about 35 quid. So it looks like a good story, good turnaround, and I've done well on, that's been one of the bright spots.
Yeah, well, you know what? It's almost like you looked at the chart on that almost, because it came from an oversold level. And literally, the RSI went down to sort of 19, and think, wow, that's oversold. And then it sort of bounced to a nice bounce, and almost doubled from that low level here. Sometimes you know, when a company's oversold and undervalued, and people sort of realize that you can do that technical just bounce, can't it, nicely, and but that was good timing on that fella.
Well, I mean, it's just one of those things. You sort of like, sometimes you put your money. I mean, other ones I've lost quite a bit of cash. But before, I mean, that was a sum of the parts. Did you manage to have a look at Trufin on the sum of the parts at all?
Yeah,
I'm guessing. I'm sorry. By the way, I have to apologise. I did give you a hard time last time, so I'm sorry for doing that. I didn't. I didn't mean to.
Normally, I've got literally a silly sort of 10 tab pretty much spreadsheet. I always, for every results come out, I fill in, but I was a bit late. But no, Trufin, it's at the moment it's very hard. It's all speculation, because the big deal really is Targo is their big deal pretty much, and PlayStack. And they're the growth drivers, and the growth there is phenomenal. But they've gone from a lending business to software as a service business. And I talking to James, and of course I look at the broker notes, because they talk to probably the management a lot more than I do. But even James is saying, listen, in a couple of years' time, we're going to have EBITDA margins of 40%. This is that's the business is going to be. And if you just look at the top line growth, in fact, generally in a software as a service business, recurring revenues and a high growth multiple like that, what would you put the EBITDA on as a multiple? What would you use for a software as a service business?
Well, it depends. If it's got a broad customer base, okay, and a lot of uses applications, and is a platform, can be effectively lifted and shifted into other areas, etc. Then for a fast growing 10-20% SaaS type business, you'd say, well, 5 times sales, depending on how large it is, etc., and what the addressable market is, but easily 5 times sales, if not sort of like 6, 7, 8 times sales. And that's how I would sort of value. But you've got to make sure it is actually a SaaS type business.
Yeah. No, that is. I mean, I think, you know, if I was James, I'd, you know, spin off a couple of places that I maybe stick with Stargo, PlayStack, but yeah, but Stargo. I mean, if you look at that, I mean, you know, the brokers have penned in sort of 35 million next year of top line sales. That and so that would bring you out on 5 times sales around about sort of 189. That's 136% up from here. But I
Wow.
think yeah. So I think it's going to grow a lot faster than
But
that.
they
I mean,
only own 80% of it, don't they? They own 100%.
yeah. But it's yeah, it's interesting. As it, you don't know how well it's going to take. I mean, if you look at the broker guidance on the sales to Lloyd's, they're talking about 10, 20,000 customers on £100 a month subscription. So, and that's mid case scenarios. It's hard to know where it's going to go, but like I said, James is, you know, when you talk to somebody like James, the CEO, he's looked at other similar sort of deals that Lloyd's have done, and essentially, Lloyd's don't invest in microcaps very often. You know, they've got to be super certain before they do that. And the last one they invested in has become a sort of unicorn. And James went, there's bigger application for Stargo. So there's lots of exciting things there to unpack. It's still early doors. The encouraging thing is they've now raised that 10 million, which is net cash, and they say that will take them to profitability. So I'm glad of that, but not that I worry too much. If you look at their shareholder register, it's like the who's of small microcaps sort of institutional investors.
Yeah, I know.
So
no,
if they needed to tap the market, it wouldn't be an issue there. But they do state publicly, you know, this is enough money to get a profitability now. So yeah, I'm happy with that. But as there's a lot unknown. We don't know. The Lloyd's deal still has to be officially, you know, marked up, notified, and announced. And then how much sales they get from that, I don't know. But it's very exciting, you know.
Yeah. I mean, I've interviewed a few super smart sort of like small cap value GARP investors, you know, people like yourself, etc. But certainly a lot of them, like Gresham House and these kind of guys, and I mean, they all think the same. There's significant value in that particular business. Not only
breaking news: Belluscura result of placing 5 million, 85 pence done.
Oh, okay, great. Yeah. Okay, fine. Okay, I'll put something on.
Gross proceeds 6 million. Approximately 5.7 million nets. They raised a bit more than they said.
Oh, wow. God, that's good. Okay. Well, it just shows you there's a lot of takers, that big appetite for it.
Yeah. And by the way, I talked about Space and Beetle last week. There's no news out on those, but I quite like them. And they've just announced, when I was chatting to Nancy, the CEO, she said at the moment, there's huge demand for pop-up shops. And I suppose in this area, I suppose people don't want to take too many long leases out on shops and to have the overhead. So they'll supply everything from us. You know, and if you look, when I went to the first time I went out, you know, after lockdown, properly was when I went to watch Wales, Scotland in the Millennium Stadium for the Six Nations, and I went to St David's Centre, the big centre in Cardiff there. Quite busy, but the shops in between the shops were doing trade, most trade. The people wouldn't go in the shop. I thought that's quite interesting. You got different kinds of concepts there. You've got the brands who are launching promotions or retailers. But if you've got new businesses that are largely online and they want to capture footfall in high destinations like that, you get a lot of that. And now they've just announced, they said we got unabated demand for pop-up shops, and we can supply everything from, you know, the stand, the staff to the retail. But yeah, so I see them. I mean, looking at the growth there, they've bounced back from literally, you know, 2.8 million last year, which you can't count because 2020 because that's top line sales, which you can't count because 2020 was a lockdown year. Then they had 2021, and then again another 7 months of pretty much lockdown, 7 months of trading pretty much. And you had November, December, did 4 million, and the gross margin is 70. You know, I've asked Gregor actually, the CFO. So where do you see EBIT margins or operating margins? And so we're still looking into that, but you know, I think they could get up to 10 quite easily. And I think even look at 20% growth top line next few years. This is, I think, largely undervalued. I mean, I'm talking, this is, you know, several %. They've got a bit of debt there, but there's C-bills debt, and they're now generating cash. So I don't see any problem with it. So even if you do this on 2 times sales, but I mean, it's ridiculous. But on 5 times EBITDA. 2023, 2022, look at 32. In fact, 5 times EBITDA, 19 pence. We're talking about there. So yeah, I just think I know, you know, it's been taking a hit, but they seem to have got it in order. They've sort of sorted it out, and this pandemic has knocked them. They're looking at margins, they're looking at growing in a sensible way. I think for the next few years, barring COVID, I think people generally do enjoy, you know, going out and shopping. Plus, I said a while back, you know, all these Instagram brands, you're amazed. Their Instagram content is largely outdoor stuff. They do outdoor stuff, take pictures of it, and do that. And I think even that, nothing's going all online. And you notice, in fact, recently, Zara's announced as well now that people are being charged to send returns back. So I don't know if Boohoo do that in the moment.
Yeah,
Zara
it will happen, I'm sure.
Yeah, 195 Zara's doing it. So Zara's a big brand. So, but you can take, if you order online and you want to send it back. So what a lot of people are doing, they're ordering same dress in 4 sizes or 3 sizes, and they'll send 3 back, keep 1. And so it's costing the company a lot of money. So Zara saying, we're charging you 195 for that. That'll be taken off your refund. But unless you take it back to the shop by hand, it's free, of course. So, I mean, that kind of thing, it stimulates, the footfall of these centers. But I think, there's still a long way. They're trying harder as well. People who work in these, high footfall destinations are trying harder with display and customer service, and just branding, experiential as well. So yeah, I just think it's a good recovery play for the next few years.
Yeah, I think you're right. Yeah, it has got all the hallmarks. I would say though, the track record of that business has been perennial disappointing. And I think the way the company,
new CEO,
I think the way investors are sort of viewing it is it's a show me stock, and it's got a lot of upside. And if they deliver, then it could really motor because
But you know what? Go on.
It's been thrown out just because it's a consumer stock.
Well, the founder, of course, CEO is now ex-CEO, and so Nancy Keller, who's been here from the start, by the way, and she's a co-founder, but she's taking it forward. And they pulled out from India, or they're in India. It's really odd. They're in Europe and India. But they pulled out from India, so they now focus on Britain and Germany, and they can expand from Germany because there's a massive mall there. But I just think going forward here, it has been thrown out. But even if you look at, if they do like for like month trading compared to last year, when last year was a bit bitty because there's only 7 months pretty much of trading from April to November-ish, they would be on like 7 million in top line revenue anyway. And like I said, I think they'll have a decent EBITDA coming through because they've cut costs by $1 million. So I think they'll be generating cash this year. And I just think they're valued at what's the EV? They're 3.1 million enterprise value, so 7 million top line.
Yeah, I mean, as I say,
they're making cash.
If you're right, it's a show me story and it will do really well. But let's see how they get on. I mean,
it's always a bit of, so all you can do is have guesstimates, but
I mean, another just as another one as a sort of like rain check on the sentiment. Is it oversold the market? Okay. One of the companies that I've invested in just recently, and I timed it in the, when Russia went into the Ukraine, is Infineon Technologies, the semiconductor manufacturer out in Germany. Yeah. It came out with its Q1 results last week. It beat its numbers. It raised expectations for the full year, and the shares dropped by 6%. It beat, it raised, and it got battered.
When the outlook was positive, is it? Was
it was better.
Costs going up or what? Or not?
Well, the cost, it was definitely being hit by freight, etc. But it raised its outlook for the rest of the year, so it beat expectations. It raised, and the shares went off largely because of sentiment. It's coming back slightly over the last few days because people are realizing actually that was flipping stupid to do that. And the reason why I like it is simply because it's one of the world's best, sort of like chip manufacturers for all things sort of industrial, for EVs, for automotive, for basically non-consumer electronics. So it's everything which is sort of like long digitization of factories and all this sort of stuff, and power. So it's got a really big sort of runway, and it should just give you an indication. I mean, it should do roughly round about sort of like 13 billion euros of sales, 14 billion euros of sales, and its order book is 37 billion. It's got it's almost like got 3 years of sales banked. So it's got beautiful coverage and visibility, and at least for next year, this year and next year. The sales went up in the last quarter by 17% like for like at constant currency, and 22% on a year-on-year basis. They're increasing margins, and a lot of that is to do with self-help, and those should increase, sort of further. And their book to bill ratio was just jaw-droppingly good in that last quarter. I mean, if you strip out the forex, it was roughly around about 2.6. You know, so they signed 2.6 times more orders than they actually took revenue for. So it just shows you the level of demand for this, you know, for their products. And I got a theory on
there. I got a theory on why companies are sold off and there is good news. I think you've got some passive investors that sit there, largely looking at, you know, the mainstream news and all the sort of doom and gloom of the economy is coming up. They forget they own shares in certain companies because they own so many. They get an email when the results come out. Oh, I didn't realize I had that stock.
Yeah, you come on. The
economy's going through hell. I'm going to sell that, get some cash in. And so I just think people are looking at the current doom and gloom and thinking, oh, well, let's get some cash in there and just sell. Anything with a bit of liquidity these days is literally, even if you exceed, there's no guarantee the share price going up. It's nuts, and that's, you know.
Well, I mean, it did not go up. It went down by 6%.
Yeah, nuts, isn't it?
Just nuts. But anyway, that's what happens with sentiment going the other way. I mean, the other one to think about is, you know, small cap stock is Trellus Health, and I know you spoke to the CEO, didn't you, Monique Fayad, and I think the COO Marla Dubinsky this week. Yeah, what did they have to say? I haven't had a chance to actually listen to your podcast because I know the one you did before was top draw.
Yeah, no. So they literally evolved the model as well. I mean, it's been a bit slow. There's a lot of regulation apparently. It's taking a lot of time. So they're now doing direct consumer as well, which is a huge market. But they can also apply that to B2B as well. So it's basically evolving business. You know, it's all heading in the right direction. Again, it's delays and COVID delays and all that stuff, but it's all heading in the right direction. But of course, the market punishes the stock. I mean, look at this chart here.
I know,
It's like everything's going bad. They got ton loads of cash there. You know, they got off the top of my head, just 30 million or something.
Yeah, that's right.
They cash to do what they need to do. So there's no worry on that front. And in my mind, in this market, the biggest worry for any company, if you're pre-revenue or, you know, is cash. And so if you've got cash, don't worry about it. But it's gone from literally 70 pence to 19 pence since. But you know, everything's on track, it seems, and you know, it's all going ahead. And in fact, they're evolving and diversifying the business. So there's less sort of, you know, sort of threat.
And I think that you need to step back at these really sort of, you know, times of market dislocation and just look at the long-term fundamentals. I mean, there's two things to really think about here. One, obviously, you know, it's delivered, you know, on a digital basis, so in telemedicine, and what they're doing effectively is replacing the resource heavy and expensive face-to-face consultations that you need when you treat sort of people with chronic diseases like Crohn's and colitis. I mean, you have to go and see a consultant, for instance, at the QE once every 3 months and this sort of stuff. So it's expensive. So you take out that. And so it becomes a cheaper and more effective and real-time delivery model. So there's no doubt about it. You know, telemedicine was going to happen. It just is going through a bad patch at the moment. And then also, as we've talked about it on numerous occasions, if you're in technology or particularly medicine, then absolutely migrate to best-in-class technology, best-in-class science. And these guys have it. I mean, you know, they're backed by Mount Sinai, who discovered Crohn's originally anyway. So when you put those two things together, the long-term fundamentals for telemedicine work, and they are best in class. In fact, by far and away best in breed in this particular vertical. So they should be a winner. And when you see the shares fall off just ridiculously, then you know they look like
well, exactly.
very, very fundamentally undervalued.
Yeah. If you had cash in this environment, a lot of cash, you know, as an investor, I think the only problem you have is trying to cut down the opportunities because there's so many out there at the moment. And people understand that. I did say, like I said, that fear and greed index, it's a contrarian index. And if you look at the time that's gone to single digits, you know, you give it a couple of months and literally the index has been higher. You know, and that's calmed down. So it's a moment. This is an opportunity. The market doesn't tell you it's an opportunity because it's surrounding fear and gloom and doom. But it is an opportunity, and I just wish I had more cash. That's all. You know, absolutely.
Well, I mean, again, just on that as an example, I mean, the Boohoo came out with its results, and I mean, obviously, I've lost a lot of money, and I've actually taken quite a lot of heat on social media for not
You haven't lost any money, have you really?
Well, I mean, on a paper basis, I've lost a big six figure. So yeah, I have. Yeah. But when it comes to sort of like, I've taken a bit of heat recently. Well, not recently, since I've buying it, for not averaging down, and that's an important principle that people should sort of like think about. That, I mean, I tend to go in at day one quite heavy, as I've said to you, and then don't average down because you know, I don't know where the shares are going, and I'm happy to put a decent size in at the start. Whereas other people sort of drip it in and see how it goes, and then might average down or might average up. But all I would say is that my strategy on Boohoo, I mean, they came out with, I mean, their sales were up 14% on the year to about 2 billion. They've built the actual, you know, sort of like scale of the company to sort of sizing at 4 billion, so they can easily grow and they haven't got to spend too much money. I mean, they've got plans to sort of automate the warehouse in Sheffield. They've got warehouses being set up next year in America, etc. So that should actually reduce the freight costs and also improve the delivery and reduce delivery times, importantly, to become more competitive. But for long-term investors like myself, you've just got to look at the strength of the brand, and you've got to look at the market share they've gained and held, and they are absolutely best in class in that. And when you couple that with where they've been able to operate without having been to be hindered by not having local presence, i.e. in the UK, they've just been knocking the ball out of the park. And I could see them in 3, 4, 5 years doing that in the States and also in Europe, etc. So they are chiming with consumer. It isn't a demand issue. It's basically getting the supply chain slick enough and handling returns slick enough, and also the delivery model, reducing those delivery times as they had before the pandemic, to satisfy that demand. And again, I mean, the shares are 80p. I can't remember what my buy-in price. It was about 260, 270 or something. So I mean, but you know, I'm just putting that down as something that I'm going to hold and just happy to. And that will come good over the fullness of time. So I just wanted to point that out as an example of what you're talking about.
Yeah, I did a webinar on scaling in and averaging down on Wednesday, and I give, so I said, and I always do it because a lot of it, maybe I think maybe with you, because you know about stocks, you know about valuations, and so you get quite confident, and then this is a good valuation, and then go for it. With me, I think, have I got this right? I don't know if I have. So the market may be wrong. I think the market at the moment is wrong. The market often disconnects. It always oversells because it's largely ruled by emotion of people buying and selling, overselling. So whenever I buy a stock, I think, right, it may be a good valuation. It may be growing, but I don't know if I'm right at this level. It may go lower. So that's all I'm worried about. So I think, first of all, if you average in over a bit of a time, it gets you a better price. Secondly, it sort of takes the emotions out of it a bit because you haven't put everything lumped in. You think, oh, you don't worry too much about it. And then thirdly, if you got it wrong, then, and if you're scaling in, for example, and you say I'm doing 10% exposure maximum to my portfolio of this stock, and if you're scaling in, say maybe even in 10 chunks, and you're halfway through, and the business goes wrong, you think, okay, you're only 5% exposed to a certain extent. So I do it for several reasons, but yeah, and I understand it either way. But sometimes, like I said, I've gone into companies, just gone big first time, thinking this is way undervalued, and I've gone in. And then I've got it wrong a little bit. Or the market just taken it lower. So I was like, so sometimes it can happen either way. But sometimes I've scaled in and it's gone up in bull markets and I haven't got enough in there. So that's annoying as well, isn't it? So either way,
I mean, and the other thing I would say is that we actually operate at slightly different ends of the food chain, because it's easier for me to dump a big 6 number in, basically Infineon, SAP, Aviva. Yeah. I can do it without just the touch of a button. Now you try and put £500,000 into space and people. You've just the shares would treble.
No, but even now it's like, that's the trouble. I mean, I've got 6 figures in space and people. I own 6% of the company. I can't dump that. I've got to have a high level of conviction in that. And part of the reason why I do it is it makes you do lots of research, because I can't just dump that stock. You
couldn't. You'd really struggle. You struggle getting in and struggle getting out.
Yeah. So I'm hoping that will become a double-digit market cap, and it's a single digit at the moment, and there'll be a lot less liquidity. and it'll get a better business. And if I want to scale up, then I will. My exit will be a lot easier. And that's what happens to a lot of companies. I mean, at the moment, I can't get out of them anyway if I wanted to. So because they're too small, but that's fine because I have conviction in them. If they start going wrong, I'll just take a haircut on them. But I have the conviction they do well over time. So, and that's it. Over time, it's fine. They grow at the size where there will be liquidity for me. So that's fine. But it's, and as yet, if you look at everything I've invested in, there's been hiccups, of course there are, with all businesses, but largely they're on track, and you just got to give it time. You can't help things. People mistake the market sometimes for the economy or the business. Just because the share price goes down doesn't mean the business has gone wrong. It just means the market's gone down, So don't jump out of a business because the whole market's selling off. That's ridiculous. If anything, you should, average in, and buy some more. So it's an interesting business, though. I think times like this in the market are quite interesting. It's emotional, but interesting,
Yeah.
I mean, another one. Cash.
Well, another one. I've just got, I'm parking. I've lost money on it so far, but I'm happy to hold. Is Amryt Pharma, and I know it's US listed now in its ADSs, but its shares are roughly around about $7.80 per ADS in the state, $7.80 in the States. And it got a patent approval for its MyCapsa, and it also which approval in the US, which is great. Helps the IPR, and it came out with results, or quarterly results a couple of weeks ago, which were great. They were absolutely in line, and they've got a really sort of like good level of sort of like catalyst going forward, potential value drivers in the next 12 months. So, I mean, I could see this one. I mean, I can't remember. You have to do I did a risk adjusted sort of some of the parts of its products. And I mean, I can't remember exactly how much it came out with, but I've got high teens sort of like valuation, but you've got sort of like, the brokers are on a much higher position. I mean, you've got Stifel, I think, is their house broker, who does a risk adjusted pipeline, and they reckon it could be worth $30 to $33 dollars per ADS. So I mean, there's significant upside, but I reckon it was about, I think if I remember right now, I'd have to look at what it came out at, but it's about $17, $18, $19 per ADS, which is well over double. So I'm happy just to hold that. And again, one of the big value drivers is that they're sitting down with the FDA with their oleo gel this month, hopefully, so certainly by the end of the month. And they should have how they're going to resubmit their application. But given that they've actually got approval in Europe, and they should be able to market it by the end of June, and there should be strong demand, I'd be stunned now if the FDA don't. Well, management have got say it's a 60% probability that they're going to get FDA approval in the Q1 results, and I think there's every chance now. So. One to watch. I mean, I would say is that anything when it comes to sort of healthcare is difficult. But as I say, I'd written oleo gel off in terms of my valuation, and still thought there was upside. And with that in there as well, I mean, it's going to drive further value accretion for shareholders. So again, I'm really positive on the market, and I think you are as well, simply because you see lots of opportunity, but also your shares have been battered. We've come through this, and if you've been beaten around, your stocks are low, and you still think there's lots of fundamental upside, it will come through at times. So it means what it means in the next 2 to 3 years time, over the next 2 to 3 years, you're going to get better times. You're going to have some nice days where you can put a shirt on like you, and you can have a drink.
yeah, exactly. I can't afford the drink yet, but I got the shirt. But no, but do you know what? It's true. It's true. And when you think of it, the stats show pretty much bear markets. And in fact, just go back to that indices chart. If you look at the highs on the indices, if you look at AIM, it was the first one to hit a high. What was it, back in 28th of the 8th last year? Hit a high. Now the rest of them a lot later than that.
Yes.
And so. And then stats say pretty much, I mean, apart from the Fed pumping money in and injecting steroids, financial steroids into the system. Generally, 18 months bear market, 5 years bull markets. So maybe a little bit less, a bit more. It's been 10 years with the recent one, but that's the way it works. You've got to put up with this uncomfortableness. It's like being a business owner. It's not all plain sailing, but the good times will come back, and the good times last longer generally than the bad times. So that's what it is. It's opportunity, and in fact, they're cheaper now than ever was. So I get more the more it sells off, pretty much, honestly, the more bullish I become because the valuations is.
And also the more you learn when it sells off, and that makes you, one, more resilient going forward, but two, a more astute investor, as in going forward as well. So being back,
I've asked my wife if I can mortgage the house. She said no way. So that's the one thing I wanted to do, pay off the mortgage.
Yeah, don't do that. Don't do that, matey.
No, I won't. But part of me is like that. Where can I get some more cash from? I know one of the worst things.
Yeah, you don't go. Don't use derivatives or margins or anything like
that's
that.
Where people
but I would say part of investing, and I would say this is a prerequisite, is to make mistakes, is to get battered, get the experience, to then to be able to to learn more and get better at it. And you will always keep having to refine. I mean, I've been doing this for 30 years professionally, or not professionally, but 20 years for professionally, and certainly been investing hard for 30 years. And the first share I bought was back in '84 anyway, was BT. So I've been in the stock market for most of my life, okay? Mm-hmm. But even after all of that, and being battered through lots and lots of cycles and lost of money, okay, in numerous occasions, my hit rate, because I'm most still have been in small caps, etc., is still only, about 2/3. So 1 in every 3, it doesn't work. So you just got to accept you're going to be always wrong. You're going to be always having to be humble. But the good side of that, even though you feel battered and feel, this is a bad news, is that you're always learning.
Yeah. No, do you know what? I said recently, I tried to implore to my son to say, do you know how long humans have been around? We've always been learning. We've now created computers for the last 10, 20 years. And only now are those computers starting to learn. That's AI, and everyone's touted this AI. We've been doing that for years as humans. That's how it's sophisticated, amazing. Learning is amazing. It adapts, and that's it. And so it's phenomenal. And now, though, it's one of the hottest areas around AI. Yeah, but humans have been doing that for ages, and we don't appreciate that. It's it's amazing. Cool, marvelous stuff. And anything else?
You're away on holiday, aren't you, next week?
Yeah,
and I'm on away in 2 weeks, so we'll have to try and sort out a time
after that. Okay,
yeah.
Cool. Marvelous.
All right, mate.
Cheers,
take care.
Speaking 3 weekies.
Bye.